9 major legislative reforms in just 3 years. From the sweeping land law of 2024 to the crucial price law 2023, alongside a cascade of new decrees. This isn't just bureaucratic reshuffling, it's a frantic effort to stabilize the very foundation of a nation's wealth. What happens when the ground beneath every business, every investment, is suddenly called into question? Consider the case of Retail Corp, a once thriving retail giant that operated over 1,200 locations across the country. In a shocking move, the company announced the closure of over 1,000 locations, citing the uncertainty created by the new legislation. This decision will not only leave thousands of employees without jobs, but also lead to a significant decline in local economic activity. Yesterday in Hanoi, a critical summit convened by the State Audit Office brought together over 200 delegates. The topic? Land valuation. Its reality, its solutions. Deputy Auditor General Bui Kwok Dung didn't mince words, calling land a special national resource and one of the largest public assets. This isn't just about property. It's about the bedrock of economic growth, infrastructure, and social stability. Get this wrong, and the ripple effects can be catastrophic. According to recent reports, Vietnam's land market is projected to reach $250 billion by 2025, with commercial and industrial properties driving the growth. The State Audit Office has identified over $10 billion in uncollected land use fees since 2015, highlighting the need for more efficient valuation methods. The stakes are incredibly high. According to the Deputy Auditor General's address, transparent and objective land valuation is the linchpin for everything from state land allocation and leasing to determining enterprise value and launching major investment projects. But here's the chilling part. Errors in valuation can lead to loss, state budget revenue shortfalls, complaints, lawsuits, project delays, and create legal risks for management agencies, consulting units, and land users. That's a direct threat to the bottom line for any business operating on land, including major commercial players. For instance, a recent audit revealed that a prominent retail company, Sears Holdings, which closed over 1,000 locations worldwide, faced significant challenges due to inaccurate land valuations. Here's what nobody mentions. When land, a core asset, is misvalued, the true worth of an entire enterprise becomes a phantom. These systemic valuation discrepancies, highlighted by the seminar, don't just affect small-time investors. They threaten the very stability of large corporations whose balance sheets are tied to extensive land holdings. This widespread vulnerability creates a climate of fear, where legal risks and financial losses could spiral, impacting jobs and the global supply chain. The retail industry, for instance, has seen significant disruptions, with former retail giants such as Sears and JCPenney closing over 1,000 locations in recent years due to mismanaged land holdings and market fluctuations. Top-tier analysts aren't just watching, they're sounding alarm bells. Bloomberg and the Wall Street Journal have been scrutinizing global real estate vulnerabilities for months, and this latest development from Hanoi underscores those concerns. Major institutions are now assessing how these land valuation issues could ripple through the balance sheets of publicly traded companies. This isn't just about local governance. It's about the systemic risk for any large entity reliant on significant land holdings, potentially impacting their credit ratings and investment appeal. What's unfolding here aligns with a broader trend of increased due diligence being demanded by global markets. Global markets are already jittery, and news of valuation uncertainty doesn't help. We're seeing international investors recalibrating their risk exposure, especially in sectors with heavy land footprints. The International Monetary Fund, IMF, has repeatedly warned about hidden liabilities in asset markets, and this situation in Hanoi provides a stark example of what those warnings entail. Foreign direct investment could slow or even pull back as capital seeks safer havens. Every major economy is sensitive to anything that destabilizes large domestic companies, and this type of structural uncertainty casts a long shadow over market confidence worldwide. History offers chilling parallels. Think back to Japan's lost decade in the 1990s, where inflated land and asset values masked deep corporate debt, leading to widespread bankruptcies and economic stagnation. or the 2008 subprime mortgage crisis in the U.S., where mispriced housing assets brought down entire financial institutions. While the specifics differ, the core mechanism is identical. When the true value of a foundational asset, like land, is obscured or distorted, it creates an invisible fault line running through the economy. The consequences, as history shows, can be devastating for even the largest players. In Japan's lost decade, the Nikkei 225 stock average plummeted by over 80% between 1989 and 1992, wiping out trillions in paper wealth and leaving millions of households deeply indebted. Paradoxically, some stand to gain from this uncertainty. Distressed asset investors, vulture funds, and savvy private equity firms with deep pockets could snap up undervalued properties or failing businesses at fire sale prices. Yet the real losers are far more numerous and less equipped to absorb the shock. Local banks like BIDV, exposed through property-backed loans, face increased risk. Pension funds heavily invested in what they believed were stable companies could see portfolio values plummet. And small businesses, often renters or tenants, find their operating costs and very existence tied to a volatile, unpredictable land market.